Good afternoon, everyone. Welcome to today's webinar, How to Trade High Volatility Products with Success. Today's presenter is Jeanette Young. Ms. Young is a technical analyst, hedger, market strategist, trader, and published author. Welcome, Jeanette.
Thank you for having me. It's a pleasure to be here.
Thank you. My name is Tom Hartle. I am CQG's Director of Product Training. I'll be your host and moderator today. Before we get started, I want to mention a few housekeeping items. If you have any questions during the webinar, please enter them into the Q&A section window at any time during the presentation. We'll have Jeanette answer the questions at the end of her presentation. If you're viewing the presentation in full screen mode, you can find Q&A in the WebEx toolbar at the top of your screen in the drop-down menu on the far right. If you're having any sound issues, please contact the host via WebEx chat. We'll be recording today's webinar, and it will be posted within 48 hours to the events section on news.cqg.com. All registered attendees will receive an email with a link to the recording. Now it is my pleasure to introduce our guest presenter. Jeanette's career on Wall Street began in 1981 when she joined Thompson McKinnon Securities. Over the years, she has garnered experience as a portfolio manager, options strategist, hedger, operations principal, bond principal, pit trader, and overall general market trader. Ms. Young worked for the NYBOT and later ICE exchanges, where she wrote, produced, and aired 2 market reports daily covering the financials, currencies, and softs. She's a frequent guest on Fox, CNBC, Bloomberg, Yorba TV, CNN, and others. She currently publishes every Sunday night her newsletter called the Option Queen Letter. Welcome, Jeanette, and now I will turn the webinar over to you.
Okay, thank you for having me. Everybody ready to put their trading shoes on or get some information about how to put trading shoes on successfully, we hope? Today I'm going to show you how I trade, and these are actual trades done on the demo system in CQG. They're real, they're not edited, they are what they are. We will begin the session being flat at the open, and we will always be flat at the open, and we are always going to be flat at the close. We prefer holding no positions overnight, especially given the global situations. And I'm going to be showing you how I trade the Russell 2000. Why the Russell 2000? Because the vol is somewhere between 23 and 27%. It's certainly not for the faint of heart. This animal moves, and it goes farther in one direction than the other indices do, and in either direction. The other reason I use this particular index is because the field is not too crowded, and we don't have a lot of people competing with us, and I get generally good fills. The first thing you have to do in your first job as a day trader or a trader in general is to prepare for your trading. So the first thing you do, naturally, is you have to prepare for trading. You have your entrances, your exits, and the levels where you want to go long. So the most important thing is to learn how to read the charts. There are only 3 directions the market can go. The market can go up, down, and unchanged. Unchanged can also be called a sideways market or a congestion area. My cute little picture. This is clearly an uptrend market. This is the S&P 500. Yes, I do work on the S&P 500. You can see that this market can remain overbought for a very long time. And it's an example of a market going too far, too fast. If you look at the uptrend line, which is right here, okay, let's get the arrow to work. Uptrend line right here. Okay, the uptrend line will show you that we're way too far out of bounds. So I'm going to use my pencil because the uptrend line didn't work. So I would expect this market to return to here. And if it returns to here, guess what? You're still in an uptrend, and it doesn't mean that you're going down. I also want you to note right down here the stochastic indicator. Take a look at that. It's been overbought since May. Now into a bear market. The first chart I'm going to show you, and I guess you're wondering what this is, a bear market, or not a bear market, a downtrend is lower lows and lower highs, whereas an uptrend market is higher highs and higher lows. So this market has declined, as you can see, from the trend line which I drew for you. And what we have right now is something that looks like some stabilization in this market, and it could go back up. But it would have to break through this line for it to become positive. And it would have to break through it for more than one day. Otherwise, I wouldn't consider it positive. By the way, in case you hadn't guessed, this is a chart of the gold market. This is a chart of the gold market this past Sunday. And this chart clearly shows the rounding bottom at this time, which is something that we might have thought would happen. But again, until you go through this congestion area here, which is going to hold you down, you will not become bullish or scare the shorts into covering their positions. This is just a picture of a really dreadful market. It is called sugar. And sugar has been declining, and there's no reason to believe that that would be bullish. This is the old picture of the pit. Believe it or not, that's the sugar pit. And this is on the New York Board of Trade. Today, of course, we're all electronic. Nothing gets filled on these pits, except for we do trade at the NYMEX, we trade options, and at the COMEX, we trade options. This is a daily chart of the Russell 2000, which is the chart that we're going to be talking about. Now, notice on this chart, I'm using horizontal lines. I like horizontal lines because they show me the support and resistance. I use trend lines mostly, and I do confirm my direction with the indicators I have on there. I have a stochastic indicator, which is right here. And I have what I called a juiced up CCI. And I'm experimenting with this one, which is a VWAP. However, this is incorrect. The arrows are upside down. But, you know, it's a study in motion. This is the Russell 2000. Now, the reason I wanted to show you this chart the next day after the chart I just showed you previously, this chart, is you see how it looks like this? This is a bull flag. And you get the feeling that it could be a bull flag, but we're going to look at the horizontal line here to make sure it doesn't break it, because if it breaks it, then it's not. And we're going to go back and look what happened. So we identified the support right here, and we definitely identified the resistance right here. Does that mean it's going to stop it? Not necessarily, but it means that it did stop there. So we definitely know that. And this is what happened the next day, which clearly broke through to the upside. So here's your trend line. Here's your uptrend line right there. Sorry about the drawing, not so good, but at least a try. And here's your downtrend line. This is a daily chart. Now, as I told you, I look at daily, weeklies, and monthly charts. Monthly charts only once a week because it's foolish to look at them, you know, less time because it's not going to show you much difference. And here is what the weekly chart looks like. So what I did on this chart is I pulled out the lines further, and it tells me that so long as we stay inside this area here for the rest of the time on the weekly chart, now this is not a daily, this is a weekly, it tells us that by July 28th, we will have something called a point of inflection. This point of inflection tells you that when the lines cross or meet here, if in fact they do, that the reaction to that will be a violent move. It's going to be a violent move either to the upside or to the downside. I can't tell you ahead of time which way it's going to go, but I can tell you to go with the trend and not to fight the trend. And this is a monthly chart, and it shows you that these trend lines actually work and are consistent. So you have to establish the direction of the trade, which we clearly have. Then you have to confirm it with longer charts to make sure that you're not wrong, and check the conditions of the trade. Now, when I'm looking for a trend line going up or down, I'm using an indicator or an oscillator to verify my findings. I am not trading off of indicators or oscillators because they are too whippy. So you must know where support is, you must know where resistance is, and you have to measure the range of the market. Why do we measure the range of the market? Because we want to know where our risk is. We can pretty much gain or garner from that how far we can go where we will feel the pain. So it's important to know where that risk is. I use horizontal lines because they're very, very helpful in day trading in establishing where support and resistance are on that day trade. Here's a trade flow chart. This is one of my favorites. I use trade flow constantly. I use it on all but one of my screens, which you'll see. And you can see how horizontal lines are working. So this is a 10-minute chart. So I will explain how I use it in the next charts because I'm going to show you my actual trading screen and my actual trades as I put them in. But what you see is support here at this line. You see that up here there's going to be resistance. All the people that were long up here are going to probably bail out. And it's a very useful trading tool to watch this. Also, you see that the stochastic indicator here on the bottom is showing you that it's thinking about going the other way. So we'll see how she behaves on the next chart. Okay, so this is my trading screen as I look at it, and I alter it from time to time. And what you can see is the DOM trader on the left over here. This is a DOM trader. Okay, I could take that off. That wasn't too cool. And you can see my screens. My screens are 2 minutes, 5 minutes, 10 minutes, and then I'm using a candlestick chart here for a 15-minute, and I'm running stochastics on most of these charts. So notice I have a buy on my DOM trader here, and I have put it there for a specific reason. Why have I put it there? I'm going to explain. And I also have a sell. When I put in a buy, I put in a sell. When I put in a sell, I put in a buy because I want to set my limits ahead of time. So these are all limit orders, and they're not market orders. What I am looking at on my chart right now is I'm looking at a horizontal line right here. This horizontal line is telling me that the trade is trying to push through it. So the trade is pushing harder to the upside. And what you're seeing is a lot of volume here because there's a trade flow chart. You notice that it gets brighter and thicker the more volume you have, and it gets thinner the less volume you have. So the way I trade this is very simple. I see that it stopped cold at 1138.40. 1138.40 is not where I'm going to put my buy order. I am putting it one tick above right here because it's important for me to see that it went through. And if it goes through, how am I deciding where to put my sell order? I'm looking at this candle here because this candle is going to tell me where I need to get out. Now, I'm not trying to make a great deal of money on the trade. I'm trying to do what I call snatch and grab. Snatch and grab is I'm looking for profits. I'm looking to be profitable. I'm not looking to lose money. Also, need to point out to you that on each one of these charts, you see the horizontal line on the 2-minute chart, and you can see it on the 5-minute, and you can also see that, let me see if I can get this. No, I can't. So the stochastic here is confirming. The stochastic on all the charts right down here, they're confirming. So we know that the trade is probably going to do well. Here we are, and we're just a little bit later, and we can see that we went long right here at that level, and we are gone. We're finished. The trade is over. We have no position. And if you didn't, and I'll show you what that looks like after it. So The stochastics help you understand that you're correct in the direction of your trade. So this is another interesting chart here. So this is 9:38 in the morning, and I'm going to point out to you the low on the chart. It's right here on the DOM trader. So we have horizontal lines here and here, and okay, let me draw that right there. Your horizontal lines. Here's your horizontal line. Okay, and this is the thing you got to look at, the low. Now, as an ex-pit trader, I know full well that if the market sees a low, it's going to want to try to test it. Not only is it going to want to try to test it, it's going to try to find where those stops are resting, because that's the whole game. See how far it's going to go. See if someone here is going to want to sell just to get out, to bail out of it. So I'm trying to take advantage of hysteria and take the trade. So I will put the trade on one tick below the low. If the trade is any good, it should whoosh down quickly. It should go right down. If it's no good, I'll bail out pretty fast after that. Okay, so right now you can see now we're at 10:31. So that trade, by the way, was a profitable trade and it made money. At 10:31, I'm now looking on the upside. So what am I going to do here? Here it is, horizontal line again. I've drawn a horizontal line, and it's telling me that if it gets here, right here, that I'm going to want to be long. So I put in a buy order here at 11:38 because the high, or that high on that horizontal line was 11:37.90. So again, I'm one tick above, and I'm putting in my sell to get out. Now, you can use trailing stops on these orders. Trailing stops work well. They work the best when you're at absolute highs and absolute lows on the day. So I don't use trailing stops because sometimes they back up a little bit and they can stop you out too quickly, and I may not want to be out as yet. Here's my P&L from those early trades. Excuse me. Okay, so you notice that is your gain for just a little bit of time. Not bad. Just keep it up, right? So here we are at my charts again. So remember, it's 2 minutes for here, 2 minutes, 5 minutes here. Here we are at 10 minutes. Now, if you've noticed, I trade from the 10-minute charts. I do not trade from the 2-minute or 5-minute charts because they are too whippy and they're not going to give me good signals. Right now, you can see on the DOM trader, you can see I am long at 1160. Why would I be long at 1160? Because I got the horizontal line and I moved right into the trade. I also put a sale in here at 1132.90. Now, I'm not married to that number and I may change it, but for the most part, they do generally get filled. If you see that it's not hitting that number and you're not getting to it, certainly bail out. The reason it's so far away is because I see this long candle here, and I feel that one right there and that one right there. And I feel that it probably will go up, and I have a good shot at making some money on that trade. I also know that there's a horizontal line here, which may hold me down. So here's my P&L from that day. This P&L shows a profit of $330, which is fine and good, considering that we're only trading one lot at a time, and it's only the morning session. So, you know, at this point you can go down or up. Down does not sound very good to me, and I don't like going down. I like making money, like we all do, I'm sure. And here's a P&L later, It's the whole P&L for the whole day. Now, I told you I'm going to be flat at the end of the day. So I've done quite a few trades. My trades all have been profitable, and I am now flat, and I'm out of the market for overnight. And I may crawl in early in the morning as I've shown you. I've come in at 7:15 or whatever, depending upon what the market looks like and what I'm seeing in the market at that time. Okay, here you are, June 4th at 7:59 in the morning. I am now establishing where I want to go long, where I want to go short, and what I want to do. So I have my lines here. On the DOM trader, you can see the low, and you know I'm going to put the order in to sell one at 11:17.50. If it doesn't go quickly through that 11:17.50, and for example, if it goes 11:17.60 and then it goes to 11:17.50 and goes back up, I'm in a bad trade. I really, really should get out of it because it's likely it won't make money. But you can try, as long as you're vigilant about getting out and don't risk too much. Now here, we can see that at 11:44, the trade before was 7:59 in the morning. So that was for the formal opening. So you can see that this market just broke out from that horizontal line, and it is going higher. And again, look at the 15-minute chart and look at your stochastics. They're all telling you something. Again, you don't trade off a stochastic because it's only an indicator, and it's telling you overbought, oversold, and it's not telling you whether you should go long or not. It's just giving you an indication that you're right or wrong, because if this thing were turning around and going down, I might question the trade. But at this point, I really don't have to. I also want to point out to you that clearly I have an order resting probably at the bottom where the market came from, underneath the low of the day, or I could have a resting order sitting above the high of the day. I generally do put them on so that they're sitting there waiting to get executed. Here you are at 9:54. Now, these are short trades, very, very short trades. We're not in for the long haul. So here, since we are going to come up again, we will go down. Excuse me. I'm expecting the market to go down and penetrate that line right there on that 10-minute chart. You can see it right there. I also have a stoke which is beginning to curl over. Hasn't done it yet, but it could. And I have my sell order on the DOM trader here at, you guessed it, 11:29.30, one tick below that horizontal line. And my buyback is right over here, 11:28.90. I tend to like putting in my orders at numbers like 11:28.90 rather than 11:28.50 or 11:29 even. I think that the market becomes too crowded at whole numbers like that, and these oddball numbers work better. So here we are. I have a trend line on the 10-minute chart right here, and I'm showing you the trend line also because I use trend lines frequently. I use horizontal lines, and I use trend lines. It's also showing me down here, look, you see the stoke still giving it up, and the stoke still giving it up here. Now, a little bit of word here about the 5-period exponential moving average, which is on this chart. If you are below it, it is a good bet that you're going to go lower. If you go above it, it is a good bet that you will go higher. So that's something you need to watch. Also, look here. You have the CCI, which I call my revved up CCI. It is also giving you that. And it's a 15-minute chart, and it's a candlestick chart. So I just use it for reference, although I do trade off of trade flow charts because I like them. Here you are, June 6th. This is jobs data day. Oh, my God, the jobs report, 8:30 in the morning, and look what happened. It was a good report. And after that report, what happened? We went sideways. It was not a good trading day after that because you have to basically trade in between here, and it's a little bit on the risky side, not exactly a trade I would like. So here we go. Russell 2000 on June 11th. June 11th, here we are. We have some horizontal lines for you, and I have to move my trading tool because I can't really see it. And we have what's beginning to look like a bull flag. So we have horizontal lines on the daily here, and you have them here, up here. So I expect it could go higher. We do have a pivot right there, so you have to be cognizant of that. You have indicators which are telling you, and this is a daily, that, and this is your prep work for your daily trading on the 11th. We're going to show you the trading on the 11th. What it's telling you is the Stokes coming down. I'm getting a sell signal here, and I do not have one on my VWAP. That's an incorrect one, but do not have it there. All right, so here we are at 8:57 in the morning on June 11th, and if you can notice right here, we have a sell signal. We have two orders sitting on our DOM trader. Actually, there are two. There's a buy and a sell. As I told you, I put in buys and I put in sells at the same time. So I would like to sell it at 1165.10, and I would like to buy it back at 1164.70. So the reasons that I've chosen those numbers is consistent with what I've been saying. It is right below that horizontal line. Now, why do I think it's going to break that? Because if it breaks that, people are going to bail out and want to get out. Will it go all the way to this level? I'm not entirely sure it will. So I'm going to make my profit a little bit more shallow, and I will move forward on that trade. Here we are. Now, we have, it's 9:07 on June 11th. And yes, I trade before the market does go open, if I have a good reason to, but I have to have a good reason to. Now, right here and now, I am bullish. So, well, I'm bullish for 2 seconds maybe, or 3 minutes, or something like that. So my buy order is going to sit here, right here, at 1169 even. Yes, it's an even number, but it's not an exit, it's an entrance number. So, and it's a dime ahead of 1168.90 because that's the way I've been trading successfully and happy with it. Also, we don't have much guidance from this. It's not telling us much. It's telling us maybe, maybe. It could go up, it could go down. So you can't rely on that very much. Anyhow, onward we go. So 1126, now what happens? Well, now, if I didn't get filled up here at 1168.90, which I did not, I am looking at its continued behavior, and we have another horizontal line down here for me to look at, and it's another trade. So I also have the stochastics agreeing down here that it should be sold, and we are below the 5-period exponential moving average on the 2-minute chart. And I have on the DOM trader, look off to the left right here, you see that I have the sell and I have my buy. And they are put in together, both limit orders. Again, don't be afraid to move your orders, not the sell in particular, but you could move it. This chart is also showing you that I have 3 resting orders on the sell side, 3 resting orders on the buy side. Again, it is likely I have orders sitting above and below the market, even though I'm not showing it to you. And again, the use of trailing stops works really, really well, and I do like trailing stops. So here's our execution, and this is what it shows us. We did go below the line. So if we went below the line, I went short. And there it is. You can see it here. You can see the executions at my price, and you can see my buy sitting down here. Okay, so we have another execution. We only made $40, but $40 in 2 minutes isn't so bad either. All right, so here we are at a dangerous trade. Why do I call it a dangerous trade? Because you'll see why exactly. So I found that I went short at 1163.70, and that was a guess that the market was going to go down and touch the lows. So here is an instance where I put in a second order, and I usually only trade one lot at a time, and this one's going to be 2 lots. So I went short at 1163 even, which is 1 tick below that low, the day's low. So I have 2 resting buy orders right here. It's a dangerous trade because the market, in fact, did not go beyond the 1163 even number, and it was a risky trade. But some of them aren't. Some of them aren't. You have to know when to close them out. The trade at 1163.70 did make money, and eventually, and there it is, and eventually, and you can see I am now long, or short, sorry, at the wrong level, but it didn't know it was the wrong level until it didn't go lower. Sometimes it happens. So you have to be prepared to say, whoops, made a mistake, and get out. That's part of being a trader. You don't want to hang in there and lose money. So I draw uptrend lines on the trade flow chart, which I told you I like. Because to me, if it breaks the uptrend line, it's giving me another indicator. The uptrend line is also coincident to the horizontal line, which is also giving me like a double whammy. The Stochastic isn't giving me anything to know. It's looking as though it might want to go higher, but I don't trust it because my other stuff is telling me no, don't do that. So I don't do that. Here's your trade flow chart, and if you notice, it did go higher, came back and went right through it. And there you go, and that's the horizontal line that was violated right here, violation. So it's telling you it's likely going to go lower. The Stochastic is backing me up and agreeing with that. And in fact, here's your 15-minute chart, and this is 10:45 in the morning, and yes, it did go lower. I'm having confirmation from my indicators. And I have a sort of support line here, but I wouldn't trade on it because it's not my trade flow chart. I look at it for reference, but I may not trade on it. Your Stochastic is, of course, lower. And my goosed up CCI is also lower. And I'll tell you how I do that one. It's not called a goosed up CCI, but what it is a CCI with a 5-period exponential moving average on top of it, so we get triggers, because a CCI on its own doesn't give you very good triggers. It does give you longer, better triggers than the stochastic. However, you have to wait for way too long to do anything with it. Again, here we are. We saw the violation. We did it. Now we came back up, and now we're testing that horizontal line again, right here. So let's see what happens. And it went through it. So this is telling you that, yeah, horizontal lines really, really work well. They are very important indicators. People don't use a lot of them, but I use them all over my chart. I do use trend lines, but horizontal lines I find are very, very helpful, getting me in and out of trades and showing me where I'm wrong. And that's very, very important for any one of us to know about. And here's the same day, June 11th, 1:02, in the afternoon. And again, we have sold it. We have a buy order resting, and we are sitting there waiting to get filled. Are we going to get filled? We'll find out. We also noticed the violation here, right here. There it goes again. So. And we don't have a Stochastic that's really agreeing with anything on that one. Again, that's why Stochastics are very nice, and they work sometimes, but sometimes they certainly don't work. Here's the P&L for that day. It's 110. Not great, but it's better than zero, and it's better than losing money. Nobody wants to lose money, and our game plan is to walk into the market every single day and try to make money. And by 1:04, we had put $220 in the bank so far. So it's important that you take profits and that you don't sit there and wait. And if you're wrong, please get out, because it only gets worse. Again, here we are with our low for the day, which is where we would likely put a trade. So we have no trade on right now, but it's telling us it would be a good idea to do so. All right. So again, we have no position here, and we have violated the downtrend lines, the horizontal lines, and we are going lower. And look at this candle. This is like a huge drop. So this is where a trailing stop would have helped you, because, you know, as I'm putting in orders to sell and to buy them back, I'm doing it very close, and I'm not being very greedy, because, as I told you, it's snatch and grab. But if you had a trailing stop and it went through, and if you notice on the 2-minute chart, you would have made a lot more money than I would have on my snatch and grab trade. So there are times when you do use a trailing stop, and that is a very good time to use it. This is the P&L for that day. It's $270. Well, not the whole day. I don't think I'm finished yet, but maybe I was. It's a conservative trading day, and I consider it very conservative. The daily view, again, as I told you before I start any trading day, I look at my charts, and I try to figure out what's going on. So this one's telling me possible bull flag, possible, not necessarily. It's telling me that right under here, I don't want to own them. This is telling me I'm probably right, that I don't want to own them, and this is agreeing as well. So at 9:36 on June 12th, if you can notice here on the DOM Trader, there is one position. It's highly unusual. I usually have 2 positions, as I told you, but I just put a position there to sell it below the 1159.10 level here, because I felt that if it could go below there, it likely would go to this area over here. And that was like at 9:36 in the morning. By 38, I was out. So the trade occurred literally at 10:37. Well, I'm not sure it was. It was a 1-minute trade. It was in and out, and you were done. You were finished for that particular trade. Now I'm going to. All right, and here's another trade that's going off. And you see here on the DOM Trader, I have sold it short at 1161.70. And 1161.70 is right here below 1161.80. And again, it's my 1 tick lower trade. I expect it to go to here, but I probably will take profits before that time. And I went short, and it went against me. Where do I cover? So this is an important thing for you to know. Where I cover is generally 10 ticks. I give myself 10 ticks for when I don't feel too comfortable about the trade. So that's my way of trading, because I don't want to lose more than $100, because it's $100 for each point, and that's 1 point. And sometimes I certainly do play with more than one contract, but for demonstration purposes, I think one contract is very, very fair. So I did buy back the 1161.30, and I went flat, and I got out because the trade did not go against me. It went in my favor. And as you can see, it's a $70 trade, which is no great shakes. And here's for the rest of the trading day, which is, well, it wasn't the rest of the trade. It was by 12:51, and you can see that I was up $170. And on this day, and you can see the trades where they're going below here. Again, sorry about the arrows. And you can see the low. So whenever you see the low, you know things are going to happen. A word about the lows and the highs. The first thrust through these lows are generally good trades. That's where your trailing stop should be. The subsequent thrusts are sometimes not as powerful as the original thrust, and therefore you have to watch it just to make sure that you're not getting in at the end of the flush out. A flush out is when they have basically finished selling and are just stabilizing the market and it's not going any lower. You don't want to be short at that point. You saw one trade earlier where it looked as though it was doing that, but in fact it didn't. It actually went lower. So here's the day's trading at, well, not the day's, 12:57. It was $200. And it shows you how many turns I made, the buys and the sells. The next few charts I'm going to show you are going to show you some divergences that you need to look for. Know where support and resistance are again, measure the range of the market so that you can know where you might lose and where you might not. Now right here on the Stoke, we're going higher, but this thing is doing some curl over. And but the CCI is telling us, hey, stay long, you should be long. Again, we have a horizontal line here, and I expect the market to go through it, or at least stop at it and test it a few times and then maybe go through it. Actually, today we did. This is the Russell 2000, so you look for the clues on the charts. Now, I was talking to you about a bull flag. I'm doing channel lines, which are provided on the CQG software, which give you absolute points where you can look through. If you notice, over here I kind of chopped off the top. Sometimes I do because I find that sometimes it goes a little too far and I put lines where it doesn't. So right here you see what I called a downtrend line and a bull flag, which I thought it was. And again, so if it breaks this line here, I wouldn't be so convinced that it was a bull flag. Here's the weekly chart for the same trade. And the monthly. And oh, by the way, if you notice the monthly chart here, that is still telling you higher, but this is telling you lower. So use your trend lines. They're much more valuable than a stochastic or my goosed up CCI. All right, so here's the deal. Do your homework. It's very, very important that you know what you're doing. We're talking about real money, and we're concerned about making money. Once a week, look at the monthly charts. Calculate your typical trading range. Look at the risk versus the reward. Don't lose. Try not to lose. The trend is your friend, so go with it. If you use horizontal lines, you'll likely be successful. If you don't feel well, or if you have a fight with your wife, or your husband, or your mother, or whoever, don't trade that day. You won't be able to think straight. If you're wrong, get out. The market doesn't care, and it's between you and your electronic trading platform, and it'll be fine. When you start praying about the trade, like, oh, please, I'll never do this again. If you get me out of this one, you're in real trouble. Tips are for waiters, so trust your own work or don't trade. Okay, we're up to questions.
Okay, well, thank you very much, Jeanette, for this kind of a review of classic technical analysis combined with some momentum concepts here. We really only have one question, and that is this question of all your trend lines. You just draw those by hand, and that's basically based on your experience about where you place these trend lines?
Placing trend lines. Okay, there's some documentation on using 3 points for a trend line, but I find with short trading, two points sometimes serve the purpose well. I draw them connecting the lows or connecting the highs. The problem with candlestick charts is that they kind of distort the trend line sometimes, but you learn to work with it and you see what works for you.
Okay, thank you. And how do you determine the risk reward of your trades? I know you mentioned kind of a hard money stop of 10 ticks, and you mentioned that
That's
you
a
look
hard
at
money stop because, if you're trading, it's $100, and if you're losing, $100 and you don't feel comfortable about it, that's an arbitrary number, which I choose. If you want it to be more specific, you should look at the range of the day and how far you are from that range, from the upper edge or the lower edge, to discover where you would like to put that stop.
Okay.
Because and you can also, I frequently use trend lines. So if I go above that horizontal line or a trend line and I'm wrong, I will get out. Because there's no sense waiting for $100. If I'm wrong, I'm wrong. And you just take it and go on to the next trade. Each and every one of these trades that I showed you today were actual. They were done on the demo system the CQG provides. And, oh, by the way, there were no losers. Luck, what can I tell you?
I guess one viewer that would like a little more clarification on exactly how you determine where you place your horizontal trend lines.
The points on my trend line.
Well, the horizontal lines, what the
horizontal lines, okay. I'm going to go back to a couple charts and try to pretty much, does he want it on the daily or on the intraday?
I'll guess the intraday.
Okay, I'm going to show you the intraday since that's what I've been focusing on pretty much. Mm-hmm. And I'm going to get you a chart without an execution on it. Okay, so I look at a trend, for example. All right, we have no trend line here, but this is where I would put it because you have two bars on this chart going to that level. So I would say, they tested it once, they tested it a second time, and if that doesn't hold, then the propensity will be to this way, okay? And you can see it here as well. And you find levels where you have bars that meet, and you see over here I've done the same thing. I'll go back and look for another one to show you which may have more trend lines on it. Here's a very good one. Okay, so here I'm saying if it gets through this, it might go higher. Now this this horizontal line isn't exactly right because it should have been a slight bit higher. But if I were trading on that, I would check it and make sure. Again, I only have one candle here, so I have no horizontal line because in fact it did go lower.
Okay.
And if you see the horizontal line here, you can see the candles here also.
A question about the T-flow charts. Are you using the default settings for the volume, or do you have a
Yes, I am, and I find them very useful. They are an additional guidance for trading. I like them a lot.
Okay. And our last question then will be, have you calculated your per trade expectancy using your solid trading to have an estimate of what you could likely see as a result after 100 trades?
My per trade profit, is that what you're asking about? Or
pretty much, yeah. Just what per
okay.
trade you're going to have an profit or a loss, and over 100 trades, what that would work out to be.
I'm not entirely sure I could give an answer to that, but I'll tell you pretty much. Many of the trades that you just saw were $40 or $60 or. If you would use a trailing stop on a breakout, you'd get much higher numbers, better numbers. You might get stopped out before you want. Sometimes I will take $10 if I'm wrong and it's not going higher, because you can watch the trade and you can see if it's going to go higher. You watch how it's trading. And since I'm picking levels where I think congestion exists or other people are, and they would get nervous if it was broken, then I feel confident in putting a trade there. But I never shrink from taking a loss or getting out. And if I'm only right for $10, then I'm only right for $10. It's better than wrong for 100.
Okay, thank you. And then a request on signing up for your newsletter. Is that at the end of this power presentation here on how to get your newsletter?
Right. Okay. It's you can get it online. It's www.optnqueen.com. and that's put out. It's my own website, so it's there. That's a newsletter without charts. If you do want charts, you'd have to email me, and I'll send you the chart version, which is much longer. And on the newsletter, I cover S&P 500, NASDAQ 100, Russell. I cover crude oil, the dollar, and gold. That's it.
That's a lot. Okay, well, that concludes our webinar. As I mentioned at the start, everybody will be receiving a link to the recording, which will be posted within 48 hours. Again, Jeanette, thank you very much for your time, and I want to say thank you to everyone else who's attended, and we appreciate all your work. Thanks a lot, Jeanette.
Bye. Have a great night.
Okay.